Good morning, everyone. This is Marshall Chambers, and on behalf of all of my teammates at Heritage, I want to welcome you to our second quarter 2022 Market Outlook webcast. I do have a couple of housekeeping items before we get started. We plan to have a question and answer session after our prepared remarks. To ask a question, you may click on the Q&A button at any time during the call and send us your question. A replay of the call will also be available on the website. I'm joined on the call today by two of my partners, Jay Jordan and Carrie Baronian. Our agenda for this morning will be to discuss current views on the economy and capital markets, provide insights on current portfolio positioning, and then discuss some planning ideas relevant to clients for 2022. So to start, Jay, at the beginning of the year, we characterized the economy as being in a period of transition. Can you give us a sense of how that view has played out to date?
Sure. Thanks, Marshall, and good morning, everyone. So we began the year with a constructive outlook as it related to the economy, really based on a couple of dynamics. Number one, what we believe to be strong consumer and corporate balance sheets with a significant amount of excess savings having built up, particularly on the part of the consumer, along with some pent-up demand as it relates to the slowdown related to the pandemic and again, particularly in the services sector of the economy. But we were also cautious regarding the path of inflation, cautious regarding the path of interest rates, and still somewhat cautious in terms of regarding the path of COVID. Given what we believe to be a transitional period for the economy, where some of the markets where some of the major drivers behind the last 24 months of performance appear to be at best dissipating, if not reversing, namely extraordinary monetary policy and fiscal policy, as well as some of the resultant aggressive investor attitudes as it relates towards risk in an environment of extreme liquidity. So the question today is really, where do we stand today? Economic activity remains solid, although we just saw a report this morning of economic activity actually declining in the first quarter modestly as inventories were pulled down. The consumer balance sheets still remain relatively strong, but momentum is clearly slowing. And this is depicted in a chart showing slowing leading indicators, and again in a report out of the economy, out of the government earlier today, showing that the economy is in fact slowing. But we're becoming increasingly concerned, even relative to that slowing, that some of the underlying trends, which ultimately will drive the economy, are becoming more challenging, which suggests to us that the potential or probability of recession over the next 18 to 24 months is in fact rising. So if we look at inflation as one of those trends, inflation in the last month hit a 40-year high at just under 8.5%. Now, while after going through the better part of 2021, where the Federal Reserve was suggesting that inflation was transitory, it now appears clear that the Federal Reserve is significantly behind the curve in terms of tightening liquidity conditions in order to combat inflation at rates that, again, we haven't seen since the early 1980s. While our expectation is that we see some moderation in inflation over the course of the next 6 to 12 months, just given what become more challenging comparisons, the persistence of inflationary pressures, as we think about from both a demand and a supply influence perspective, suggests to have meaningful implications as it relates to both the economy and capital markets. So first, with respect to monetary policy, we're in the midst of a pretty meaningful shift, where after 2 years where the Federal Reserve was increasing the size of their balance sheet through the purchase of approximately $120 billion in bonds every month, and ultimately, as this chart shows, doubled the size of the Federal Reserve balance sheet through putting a significant amount of excess liquidity into the overall economy and into the capital markets. The Fed is now in the process of unwinding that quantitative easing through a quantitative tightening process, which will ultimately target taking about $95 billion of selling to shrink their balance sheet to remove the excess liquidity that's currently prevalent in the system. At the same time, the Fed is now tightening monetary policy through increases in interest rates through the federal funds rate. Given, again, concerns that higher inflation rates suggest that rate increases, and this is the rhetoric out of the Fed, that higher inflation rates and more persistent inflation suggest that rate increases will be more aggressive from a timing perspective, as well as the ultimate level of interest rates is likely going to be higher. You can see this tightening policy within the real economy most clearly in the rise in mortgage rates, where mortgage rates have now risen above 5%, which suggests is likely to at least cool the housing market, which has been a meaningful engine of growth for the economy. Geopolitical tensions add another risk dynamic to the overall economy and markets. The Russian invasion of Ukraine, in addition to adding a war premium to how we value assets in capital markets, does expose the fragility of the global supply chain. This is a chart that depicts the importance of Russia and Ukraine as it relates to the global grains trade. But you can translate this across to many different sectors and areas, including energy, where Russia accounts for 17% of global natural gas supplies and 12% of global oil supplies. If you look to Europe specifically, as we think about the global economy, the dependence on Russian energy imports is about double those levels. And then supply chain bottlenecks global supply chains continue to be under pressure as a result of the pandemic and as a result of destabilized global infrastructures related to the pandemic. When we pull it, which suggests that we may be in an environment where inflation remains stubbornly high. So when we pull all of these different pieces together, it suggests the potential for a more challenging economic environment where the Federal Reserve is required to raise rates in an attempt to moderate inflation at the same time that we have an economy which is slowing.
Thanks, Jay. Carrie, can you take us through what the implications for capital markets were during the quarter, and how does that influence our view on markets going forward?
Yeah, so in financial markets, equities and fixed income posted negative returns for the quarter while commodities surged. This chart shows index returns for several asset classes. The blue bars show performance for the quarter, while the orange bars show the max drawdown over the past 12 months. You can see most equity indices were down mid to high single digits for the quarter and experienced a drawdown of 10% or more. For example, the S&P 500 was down 5% for the quarter and had a 13% drawdown. The NASDAQ 100, which consists of higher growth, more speculative businesses, was down 9% for the quarter and had a 21% drawdown. You can also see the quality value index, which emphasizes high quality businesses with reasonable valuations. It performed more defensively, down 1% for the quarter. Outside of US large cap, US small cap, and international equities were down mid-single digits for the quarter. In fixed income, core bonds posted negative returns on the back of sharply higher interest rates. And you can also see the top performing asset class by far was commodities, which benefited from supply constraints. And with equities and fixed income posting negative returns, cash was a really good place to be. As Jay just described, our assessment of the economy suggests a rising probability of recession. With extended valuations across asset classes, risk-reward characteristics appear skewed to the downside. This chart shows the S&P 500 equity risk premium, which estimates the excess return above the risk-free rate associated with investing in the index. You can see the premium has declined to about 200 basis points, which is very low in absolute terms and coincides with tech bubble levels. Looking forward, we believe the upside return potential from here is very muted compared to the downside return potential. So we believe a more cautious stance in client portfolios is appropriate, and we've taken several steps recently to lower the risk characteristics of portfolios.
Jay, the Federal Reserve has suggested that some of the economic trends may be transitory in nature. How does that square with our view?
So in thinking about the current environment, we really believe it's important to take a step back and really evaluate the long-term trends that have been driving the economy and financial markets really over the course of the last 30 or 40 years. And if you look back over that 40-year period, there are a couple things that stand out. Markets and investors have been meaningful beneficiaries of an environment of falling inflation, falling interest rates, rising profit margins, and the resultant expansion in valuations that we've seen really across asset classes. So if we look at a few of those major trends that have been behind these, a few of these major drivers that have been behind these long-term trends, well, we certainly don't have a perfectly clear crystal ball. We do believe that it's worth paying attention to a few where we believe that we may have reached an inflection point where things are beginning to shift in a different direction and certainly need to be considered in terms of the way that we are managing portfolios. One major trend has been the impact of globalization. And when we look at globalization over the course of the last 30 or 40 years, what we find is that through the course of globalization, we have been able to do a couple of things. First of all, when you think about inflation, inflation has been, or disinflation has been one of the outcomes of globalization, as we have been able to source from an abundant global labor force to fill our labor needs, which is, as a result, has resulted in muted wage inflation really across the spectrum of economies. Secondly, profit margins have been meaningfully higher as a result of globalization, as companies have been able to source manufacturing capacity from lower cost areas of the world, ultimately benefiting profit margins and benefiting corporate America. Now, the pandemic has magnified and potentially accelerated a trend that has been ongoing towards a reshoring of certain manufacturing, as companies are beginning to reevaluate the need for both security and redundancy in their supply chains. So while this is potentially positive for domestic employment growth, and what this chart depicts is the number of manufacturing jobs which have come back to the United States over the last decade, it certainly does have positive implications for our labor force. The implications for profit margins and for wage inflation are very different, and potentially suggest that we may be in an environment where wage inflation remains more persistent and profit margins come under pressure. If we then look at a second dynamic, similarly, demographic trends have provided a significant boost to economic growth over the course of the last 30 or 40 years. You've really had a combination of the baby boomer generation moving into their peak working years, coupled with a significant increase in dual wage earning households over the course of the last 30 or 40 years. And if you take a step back and think about economic growth ultimately equals the combination of labor force growth and productivity growth. So this combination of a baby boomer growth along with dual wage earning growth has resulted in a significant growth in our labor force over the course of that period of time. But these both appear to be reversing, as we've now seen the percentage of households with dual wage earners has peaked, and in fact has declined modestly over the last 10 years, while at the same time we are seeing, as depicted in this chart, an increase in retirements as the baby boomer generation begins to age into retirement. This is important, as in the current job environment where there are about 2 job openings for every 1 unemployed person in our economy. There are some temporary dynamics at play associated with the pandemic, but there are also structural issues at play here in terms of that likely reflect a tighter structural labor market as we look forward. And then finally, the U.S. has been a big beneficiary of our position as the world's reserve currency and the flexibility that has afforded us, both from a fiscal policy and a monetary policy. And while we certainly believe that the U.S. dollar remains the cleanest dirty shirt in the global currency markets, we are of the view that, and we've seen, as this chart depicts, you have seen modest diversification away from the U.S. dollar over the course of the last couple decades. And we certainly see motivation on the part of both our allies and our enemies alike to continue to diversify their exposure to the dollar over time. We've seen this in the shift from foreign treasury purchases, where foreigners have become net sellers as opposed to net buyers of US treasuries over the course of the last decade. In an environment of higher inflation, the Fed may have less flexibility and be forced to raise rates in spite of weaker growth. So when we take all of this together, this suggests to us a more challenging environment where risks are skewed to the downside, and we've taken steps to position portfolios accordingly.
Thanks, Jay. So based on those views, Carrie, can you take us through our current positioning for clients and the specific steps that we have taken to bring down risk in those portfolios?
Sure. From a positioning perspective, we're managing equity allocations below long-term targets while holding an above average level of cash to support future spending needs and investment opportunities. And we continue to build a position in alternatives such as gold, private real estate, and private credit. This chart shows a sample benchmark portfolio compared to our current positioning. You can see relative to a benchmark that's 65% equities, 32% fixed income, and 3% cash, we're currently managing to 59% equities, 25% fixed income, 9% alternatives, and 7% cash. Now, focusing on equities, our concentrated leaders portfolio continues to represent the core of our US large cap exposure. As you know, we own these businesses because we believe they possess durable competitive advantages with strong growth and income characteristics and reasonable valuations. We have confidence in their ability to weather any type of environment and generate acceptable returns over a full cycle. With that being said, we have made a few adjustments recently to enhance the risk reward characteristics of the portfolio. For example, we took profits in ConocoPhillips, which outperformed as energy prices spiked to multi-year highs. And we reinvested in Johnson & Johnson, which we view as a high quality business with more defensive characteristics and reasonable valuation. We also reduced our financial holdings that outperformed and may face a more challenging path forward. We trimmed Berkshire Hathaway and Progressive and removed Truist from the portfolio. We also tax loss harvested Facebook to help mitigate the tax impact of these shifts and reflect our fading confidence in the timing of a sustained turnaround in the company's fundamentals. Overall, we believe we continue to own a collection of really great businesses with balanced exposure to defensive, cyclical, and growth areas of the market. We're pleased the portfolio has provided solid downside protection this year and outperformed over the past 12 months. Within global equities, we reduced our exposure to the BlackRock Global Dividend Strategy. Because the fund emphasizes dividend growth, it has meaningful allocations to financials, industrials, and other sectors that are often the first to come under pressure in a difficult market environment. We view reducing our exposure to BlackRock as a step to lean against these areas and international markets in general. This chart shows the Eurozone Consumer Price Index year over year. You can see the region continues to wrestle with accelerating inflation. And compared to the US, Europe is a more open, trade-oriented economy. So it should be more sensitive to many of the headwinds Jay was discussing earlier, including geopolitical tensions, supply chain bottlenecks, and the potential shift to deglobalization. Also within global equities, we remain positive on natural resource stocks. As you know, we initiated a position in the GMO Resources strategy in 2020, which invests in commodity producers in energy, industrial metals, and agriculture. The stocks have outperformed, and in our view, they're still attractively priced. This chart shows the valuation of natural resource stocks relative to the S&P 500. You can see they've been trading at a sizable discount to the index versus historical average. And you can see on the far right side, while the line has started to hook upward, it's still well below average. In fixed income, we reduced our exposure to preferred securities and reinvested in core bonds, which are higher quality and offer a more compelling yield on the back of sharply higher interest rates. This chart shows the yield curve as of December 31st of last year, as well as the yield curve on last Friday, April 22nd. You can see the curve has steepened on the short end materially as investors continue to price in more Fed rate hikes. And you can see the curve is flattened on the long end and even inverted at points, suggesting investors are concerned higher short rates will drain liquidity from the financial system and potentially cause a recession. From a positioning standpoint, we continue to favor short and intermediate term securities based on a view we're still not being adequately compensated for taking significant maturity risk. Another dynamic at play, after dislocating in 2020, the yield relationship between tax-free municipal bonds and taxable corporate bonds has normalized. So we sold our municipal bond exposure in retirement accounts and repurchased corporate bonds, which have resumed providing a higher yield on a pre-tax basis. While fixed income performance has been disappointing broadly, we're pleased our bias toward the high quality short and intermediate term munis has provided solid downside protection over this period of time. As we said earlier, we are holding an above average level of cash in portfolios. We view cash as a very important asset class in terms of supporting future spending needs and investment opportunities in a challenging environment. Given more attractive interest rates, we purchase short-term treasuries as a cash management solution for a portion of our cash allocation. And then lastly, we increased our allocation to gold to help preserve capital in an inflationary environment. We continue to view gold as a very important long-term strategic allocation in portfolios, store of value, and potential insurance policy against the possibility of a weaker dollar. Gold has been outperforming, which we believe reflects elevated policy uncertainty as well as deteriorating confidence in the Fed. This chart shows the price of gold relative to the S&P 500. You can see while gold has been outperforming, it still appears attractively priced versus equities.
Thanks, Carrie. So in an environment where we still believe that valuations, while they have come down, appear full, and our expectation is that we see inflation and interest rates trend higher over time, we'll continue to emphasize quality in portfolios while focusing on managing risk, specifically assessing the asset allocations of our clients as it relates to their specific situations. I'm now going to turn the call over to Marshall Chambers to provide a few updates on news items as it relates to financial aid and tax planning that we see as most relevant to our clients.
Thanks, Jay. So some of the items that I'm going to discuss are proposed bills and regulations that are subject to change. And just like during 2021, we may be waiting until the last minute for clarity if there's any action to take at all. The first is some news related to a release from the IRS at the end of February pertaining to the Secure Act that passed at the end of 2019. As a reminder, the Secure Act had meaningful changes related to required minimum distributions. It delayed the age for beginning RMDs from 70.5 until age 72. It also added some rules related to non-spouse beneficiaries being required to essentially take out all of the funds from an inherited qualified account within 10 years effectively. And so it effectively eliminated the stretch IRA. One of the biggest implications of these proposed regulations would be that it may take away the option to defer taking RMDs between years 1 and 9 and effectively treat inherited IRAs similar to the prior rules. But it would keep in place that 10-year complete disposition rule that went into effect in year 2020. Since the Secure Act went into effect during 2020, this would be relevant for anyone who inherited a qualified account or IRA that was received by for a non-spouse beneficiary in years 2021 and then going forward. There are more rules related to minors and other beneficiaries that we need to be very cognizant of as well. For non-spouse beneficiaries, some of the drivers of whether an RMD may be required is it hinders mainly on the age of the deceased. If they began RMDs, the beneficiary would then also be required to take RMDs during years 1 through 9 and essentially the complete disposition in year 10. If they died prior to age 72, then they had not begun their RMDs as well. So the 10-year rule may only come into and be applied in that instance. Roth IRAs would still have that 10-year rule, but the RMDs may not be applicable because the deceased taxpayer was never required to begin an RMD themselves. So from a planning perspective, this may perhaps further increase the appeal of Roth IRAs for clients. No action to take at this moment, but this is something that we're certainly paying close attention to, excuse me. So next, Secure Act 2.0. Similar to the potential changes with the original Secure Act, it's just a draft legislation at the moment. But at the end of March, it did pass in the House by a substantial margin. It'll be up for vote in the Senate, and there's speculation of when that would happen, whether it would happen prior to the midterm elections or it would be something that would happen towards year end. Main points here are that some of the rules for employees being auto-enrolled in 401ks. There's some provisions for matching contributions by employers for employees that are currently curtailing their student debt. And then there's also some changes to the increase in catch-up contributions. And then another piece to further complicate things, there may actually be some changes related to the date at which somebody would be required to begin their required minimum distributions. So the change to the RMD dates would take effect for 2023, and it would push the age to age 73 from 72, where it is today. It would also gradually begin to increase that over the coming decades, so more or less kind of staging in some more increases. In addition to that, qualified charitable distributions, which have been very popular for client gifting strategies, has not had an increase in the value of that potential gifting for essentially the past 15 years plus. So there would potentially be an index for inflation increase for gifting capacity there. So that would be a big benefit for our most philanthropic clients that primarily use their RMD distributions to go directly to charity. Again, this is pending legislation and we cannot act on anything at this time. And so that more or less kind of rounds out some news related to some legislation and some retirement planning. Earlier, to follow up on some comments about interest rates and mortgage rates specifically, there's certainly been a big move, and we've seen that take place during 2022 on the interest rate front, and we're seeing how it's also impacting some financial planning that we're doing. Higher interest rates can be a positive for savers looking to earn a respectable yield for safe haven assets, but for the borrower side, it's coming at a cost. Relative to history, rates are still low, but to a homeowner who may be considering a move if they've recently refinanced, especially if they had refinanced during 2020 or 2021, the interest cost is noticeable. Here's a table of prime mortgage rates for the national average, which I think Carrie had mentioned earlier, are already above 5%, and compared to a mortgage obtained in the prior couple of years, which would probably be in the low 3% range, the extra annual cost is essentially something north of about $7,000. So significant change there. And it also has implications for some of our younger next generation clients that are looking to purchase their first homes. Prices are up substantially over the last few years, and now that cost to borrow is also impacting affordability. Increasing interest rates also has an impact on a number of some of our consistent planning strategies that we've embraced during this low rate environment. AFR rates, which are benchmarked against treasury yields, are still low for historical standards. These are the rates that we typically discuss when one family member is loaning funds to another. It's a great way to leverage the family balance sheet, especially if compared to rates that are available right now in the public space. So something certainly to be cognizant of. The 75/20 rates, here's a snapshot of those, which is used to calculate the present value for remainder interest. So effective for May, that benchmark rate is about 3%. So you can certainly see by the chart or the table that it's elevated versus the recent past, but still low by historical standards. So strategies that are popular in that low rate environment may still be appealing, such as intentionally defective grantor trusts, charitable lead trusts, and grantor retained annuity trusts. So if we continue to see that rates are going higher, they may become less attractive, and we may start turning to some of these higher rate strategies that may come into play, but we'll continue to help evaluate that for you. So in summary, some of these strategies may also have additional appeal at the moment, given market volatility. Also, with market volatility from an income tax planning standpoint, we can also lean on some of the traditional beneficial strategies like tax loss harvesting that Carrie had mentioned. Roth conversion timing may also be more appealing with the recent pullback in equity markets. And as discussed with the potential rules that may be changing, Roths may come with some additional aspects that are worth discussing again. 2021 was also broadly a higher income year as we've been finalizing tax returns for clients. And so for most, we transitioned into 2022 and are actively planning for what 2022 income is going to look like and how to plan effectively around that. So it's another year of potential change, crosswinds of global conflict and market volatility, and we are here to continue to cut through that information and proactively plan for you.
Thanks, Marshall. So before we take questions, and again, just from a housekeeping perspective, if you hit on the Q&A button, you can type in any questions that you might have. We wanted to make an exciting announcement as it relates to a new member of our team at Heritage. So I'm thrilled to be able to share with everyone that Steve Henderson will be joining Heritage as the Director of Private Investments and Foundation Strategies. Steve will be a member of the Investment Policy Committee, and he'll be involved in investment strategy, asset allocation, manager due diligence as it relates across our portfolios, but specifically as it relates while leading our alternative investment strategies. Steve comes to Heritage after 9 years as the Director of Investments at Spider Management. And prior to that, Steve held senior investment roles at the Virginia Retirement System. Steve is a graduate of the University of Richmond with an MBA from George Washington University. So with over 30 years of investment industry experience, we're thrilled to welcome Steve to our team, and we hope you will join us in welcoming Steve to the team as well. And we look forward to introducing you as he comes on board. So with that, we are, this is the question and answer section of the webcast, and maybe one question to start with that we received is asking a question around I had mentioned early on in an environment where inflation is rising and inflation appears to be supply based as opposed to demand based, where the Federal Reserve is trying to engineer a soft landing and moderate inflation. The question was, can you speak a little bit to the history of the Fed as it relates to their success rate when it comes to being able to engineer soft landings? And I think, to answer that question, I think that the history and their track record would suggest the economy is like an aircraft carrier. And the Federal Reserve and monetary policy is a very blunt tool. So when we think about, the dynamics of the environment that we're in today, where again, inflation appears to be less about demand side inflation and more about supply side inflation, that suggests that the Fed is going to have to be more aggressive in order to maintain one of their two mandates, which is price stability. And that suggests to us, again, their track record was challenged in terms of being able to marshal a soft landing when we were in a quote unquote demand side inflationary or disinflationary environment. We have real concerns. And part of the reason that we've taken risk out of portfolios is that we do believe, we don't have perfect clarity. I don't believe anybody does, but our view is that the probability of recession has risen to a point where we do have concerns about a slowing economy and the impact that that has on earnings in an environment of inflated asset prices. So the next question is one that I will poise to Carrie, which is, with today's announcement, could we be in a recession already?
I think the answer to that question is yes. The definition of a recession is 2 consecutive quarters where the economy is contracting. So we're halfway there at this point, and given the trends that we're seeing within the market, don't appear to be supporting a different viewpoint that we are on our way to officially having a recession here. So
thank you. So the next question is, do you think the current market will cause more corporate mergers or purchases like Elon Musk with Twitter? And how do you think that might affect domestic equities? Maybe I'll take a stab at this one. And I think it's a great question. I think one of the interesting, when you think about M&A activity, and we've been in an extraordinary environment of M&A and activity over the course of the last couple of years, given the degree of liquidity that has been introduced into not just the economy, but into capital markets. And in an environment of very, very low interest rates where the cost of money is essentially zero, it certainly has incented more activity along the lines of M&A. As we look forward in a rising interest rate environment, our expectation would be that we would see a slowing in M&A as the markets essentially equalize around an appropriate valuation level as it relates to discount rates, which are rising. And so I think that in a recessionary environment or a slowing economic environment coupled with rising interest rates, that's not really a great cocktail for increased M&A, and really becomes more challenging for the domestic equity markets in general. Okay, well, it looks like at this point that we don't have any additional questions. And so I thank everyone for participating in the call today. Certainly, if you have additional questions, you can reach out to any member of the Heritage team directly. But we appreciate you being here. We hope you all have a great day. Thank you very much.